Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you about it. Now, if you're not on my email list, it's completely free, and to get on it, you need to go below this video into the description, click the link, that'll get you on the list. Because there's a lot of things going on in the markets, and I want to talk about a serious topic today when it comes to them, and that is the biggest challenge that investors in the market now face. And I'm not talking about someone with a Robinhood app, playing. I'm talking about people that got hundreds of thousands, maybe even millions, or they got an IRA with 30,000, and they're adding in for retirement, and something very troubling has happened over the past 6 months. Now, it's not unusual for the stock market to take a drop. In fact, we had the biggest January decline for the NASDAQ ever. But what is unusual are for bonds to go down too when the stock market goes down, because typically they go up and provides a nice safety portion for a portfolio. That's why most investment advisors say put 60% of your money in stocks, and that 40% or 50%, they want to be more cautious, into bonds, because bonds historically would go up when stocks drop. Well, historically means since about 1980. Before then, they didn't do that. And now they're not doing that again. So this is creating a huge challenge for people. And I want to talk about that in this video. Before I do that, though, I want to quickly bring up Facebook, because there's something I wanted to say about Facebook this weekend on my Facebook page for Wall Street Window. But I realized if I put the comment in, Facebook would censor it. They'd make it so no one can see it. I've noticed that whenever I post anything critical on Facebook, in comments on there, even linking to mainstream news media stories, they degrade my feed so no one can see it. So I'm going to do it on YouTube. All right. I'm not going to put this on my Facebook feed. I'm doing it on YouTube instead. It's just the way Facebook is. Because the stock crashed last week. In fact, the decline in the stock represented the largest single day drop for market capitalization in any American company in history. So it was a record-breaking decline, billions of value, so to speak, eliminated overnight. Now, the value wasn't really there. What really happened was reality hit. And how can and that's reality is something you need to understand when it comes to Facebook, especially if you still have a position in it. Because the company is not what it was over the past couple of years. And that became the reality in the numbers of this became public knowledge last week. It wasn't public knowledge till last week. That's why the sudden decline. So Facebook, since its existence on the stock market, has been one of the best growth stocks. It's been one of those so-called FANG stocks, which have helped fuel the market higher. And what was attracting people to the stock was the growth in users, the growth in revenue. As each year went by, Facebook's got bigger and bigger, became a bigger and bigger portion of people's lives that use the internet. But something happened last year, which now we know from the quarterly earnings report that came out and caused the stock to drop. The number of users on Facebook declined in the last quarter. The advertising money spent on Facebook also took a decline. Now, that makes it so the Facebook.com website is no longer a growth story. And Facebook has tried to prepare the public for this shift in the future of the company by trying to rebrand it as Metaverse, not about the website that had been the story of growth for years, but something new. metaverse. So if you're a user on Facebook, you have been bombarded for months with occasional advertisements from Facebook showing people wearing these goggles. Months ago, Zuckerberg and his team were distributing videos showing people using this metaverse, but it's a concept. It's not something that's, real right now. People are not using this metaverse in any real way. Do you know a single person really doing that? It's just not happening. But the premise of the idea that they've been presenting us is that this is coming, this is the next big thing, and it's going to revolutionize everything. We've seen this type of technology hype, I would say, and I'm going to show you why it's hype in a moment, but we've seen this sort of talk in the crypto space. Look, buy the coin, because coins are going to be whatever. These crypto coins are not real coins, that's virtual, but they're going to be what everyone uses, and you got to get in now because everyone's going to use it one day. And we were told this, it would replace the US dollar way back in 2015, and few people use Bitcoin for money, the Bitcoin than they were back then. Most people that do use it, 99% is pure speculation, and the price has been declining since the summer. But that's not the only concept we've been hearing too. How about just the Elon Musk talk, not simply just about Tesla itself, but the way people describe Tesla as not a car company. No, it's not a car company. It's solar panels, it's data. It's not a car company. Well, sure, it is a car company. But now Facebook is doing a similar thing by saying, oh, we're not about the website, we're about metaverse. Now, let me show you what we learned is that, and I sent this email to some friends of mine, and I quoted from a news story here in the New York Times, and I made some comments of what that I'm telling you right now. Now, this is probably all hype, and they spent $10 billion developing metaverse last year. That was a sinkhole. No profit generated from this. It's just development. And in the news stories of last week, it said, the Facebook people said it may take a decade or 12 years for this metaverse to be realized. But here's the key quote in this story. There is no evidence the bet will pay off. Unlike Facebook's shift to mobile devices in 2012, virtual reality use is still the province of niche hobbyists and is yet to really break into the mainstream. Widespread augmented reality headsets are months, if not years away. In essence, Zuckerberg is asking employees, users, and investors to have faith in him and his metaverse vision. That's a big ask for something that will cost the company billions in the coming years and may never come to fruition. Look, there's countless inventions that people make that never become widely adopted. Most do not. Think about, you just thousands for every successful invention. There's many that do not. How about those little things, I forget what they're called, but over a decade ago, there's something you could stand on and it would move you around, and it never took off, but it was a hype for months. So he's trying to sell people the concept that this is still a growth stock when there's no earnings growth or revenue growth coming from metaverse. It's just a concept. A real growth stock, remember this, a real growth stock is a growth stock because revenues and earnings are growing. If you read the book, One Up on Wall Street, or I think How to Make Money in Stocks by William O'Neill, the classic growth stock book, Bible of growth stock investing, it says, look for stocks with revenue growth of 20% quarter by quarter and in earnings growth too. Metaverse is not going to provide that. This is no longer a growth stock, but it's priced as if it still is. That's why this is a disaster, and metaverse is a concept trying to fool people into it's a growth stock when it is not. Do not fall for Zuckerberg's propaganda. when it comes to stock. If you're in it, I would sell it. That's not personal investment advice. That's what I would do. If I own this stock, I would liquidate immediately and get out of it and find a company that pays big dividends and has its earnings and revenue tied into changes going on in the economy now, not a dream of a decade from now. All right, enough said of Facebook. There's many things we need to talk about. The ARK ETF has been another example of this hype technobabble, and it's in a bear market now. A bear market is defined by a market in which the price is below the 150 and 200-day moving averages. Those moving averages are turning down. This ARK has been below those moving averages since November. It's underperforming the stock market, and almost every single stock inside of it that it owns is doing that too. Despite that, it is still one of the most widely owned stocks among individual investors. It's on the top 100 most owned positions among Robinhood investors. If you log into the Robinhood account, you can see that. You want to avoid stocks below their long-term moving averages like you see on this chart, because what it means is that they're in a bear market, and bear market cycles can last 12 to 24 months. But even worse, the things that don't make money, that are just pure speculation in bear markets, they don't simply go down and then come back up. They tend to go down and never come back up. So this holdings in ARK are a complete debacle. But what's important is the lesson. Even if you don't own it, it's the chart pattern. When something is that far below the moving average, the moving averages start to curl down, you're in a stage 4 decline. If this is a new concept for you, buy my book, Strategic Stock Trading. It's only about 100 pages, and it explains this concept. This concept is one of the most important concepts you need to know when it comes to investing or trading in any market, any ETF, any stock, anything you're doing. It's that critical. And if you want something good, let me show you that. The opposite. Then this is something I own. The Dba Etf. It invests in agriculture futures contracts. Now, it made a secular bottom in 2020. The lowest low ever for agriculture prices compared to the US dollar. And that low was the bottom of a bear market that had been going on for roughly a decade. A 10-year long bear market ended right there. So this started as upcycle, that is likely to last for years, not just 6 months, but years. And I'm not telling you buy right now, because it is overextended. It just made a new high on Friday. And in bull markets like this, in bull market cycles, the best time to buy is on dips where the 200-day moving average gets hit. That moving average tends to act as long-term support in a bull market, just as it acts as long-term resistance in a bear market. So a drop down to that green line, 19, is about where it is now, would be a long-term buy point if we can get it this year. I don't know. I'm not selling in hopes it'll come. I just hold what I got. And I got a good portion of my money in this exchange traded fund. Roughly 14% of the money in my retirement account, and also my larger account, is in this exchange traded fund. When I talk about bonds, let's talk about bonds right now. This is a big reason why. So just as agriculture made a secular low in commodities and oil in the spring of 2020, we saw the Federal Reserve lower interest rates to zero and began this quantitative easing, or accelerated quantitative easing, bond buying program. Now they're paring that back and they're positioning themselves now to raise rates this year. But what's important to realize is that bonds go up in value when the yields that they pay go down. And when the yields go up, the bond value in the funds go down. Well, when rates went to zero, we saw a secular low in yields and interest rates, not just the United States, but across the entire world. In fact, there are bonds yielding negative yields, and rates were at the lowest points in all of human financial history going back over 1,000 years. So what this meant was when the yields got pushed down like that in 2020, just as we saw a secular bottom in commodities, we saw a secular bottom in yields. That meant that we also saw a secular peak in the value of bond funds. That reality is one of the most important realities that are going to impact investors, no matter if you're a long-term investor or a day trader or whatever. It's because it's going to impact the financial markets. It's going to be one of the biggest issues over the next decade. The fact that we had a secular blow in yields, a secular peak in the value of bond funds. And one of the most, the largest bond ETFs is this one. This one tracks corporate bonds, high yield corporate bonds, not junk bonds, but high yield, high grade corporate bonds, LQD. And as you can see, it closed Friday at a new 52-week low. It's in fact closing low is below the low of 2021. But it also, just like the ARK fund, is below its 150 and 2-day moving averages. And it's fallen down far enough away from them that it's about to make them tip down. Now, I'm not saying this is as bad as the ARK ETF or some stocks like Facebook, perhaps. However, this is also now in a bear market. It made an all-time high in 2020, along with other bond funds. The TLT ETF, which tracks the value of 20-year Treasury bonds, made a all-time high in the summer of 2020, and now it's also going down. The challenge, though, is that many Americans have 40%, 50% of their money invested in these funds because historically they would go up when the stock market went down. Because what would happen? The stock market would go down, the economy would slow down, the Fed would lower rates as a result. That would push the value of bonds up. So that would provide a great diversification for people, because when stocks go down, their bonds go up, or were. And that's great. That's how you want to invest. You want to be in things that, don't all trade together. So if something goes down, something else can go up. But because of what's the secular trend we're now in, it's not longer working that way. Bonds went down with stocks too in January, and they're likely to continue that over years. They're not going to make all-time highs. They're not going to go through the highs of 2020. At the best, bond funds are now dead money, basically, because rates are zero as we speak still, and they haven't even started raising them, even though they say they are, the Fed, that is. So this is tough. And an example is this Fidelity US bond fund is one of the largest in the world. This is just one. I mean, they're all got the same problem. They're losing money. So when the stock market had the biggest decline ever, this fund is down 3% year to date. It lost 1.6% last year. And this is one of the best managed funds, spread out, more safe, bonds, and it's losing money this year with the stock market down too. In fact, it could be that this fund at the moment is down more year to date than the S&P 500 is. It's not really that important. But I expect this fund to continue to decline in value along with all other bond funds from now over the next several years. And what people are risking then in this 40-60 portfolio is the fact that everything can go down. Something they never experienced before, something that hasn't happened since 1980. It happened in the 70s. It's happened at other times in financial history, but not since 1980. And most people have no knowledge of what happened before 1980. No, there's very few investment advisors out there that have any, they weren't managing. They didn't have careers in the 1980s. They might not even not even 1980s. They might not even been born before 1980 or even before 1990 even. So here we are, but financial history is not just what happened from 1980 to today, but what happened before is important too. And what happened before suggests that investors that think they're safe in bonds are making a dramatic mistake. So how do you fix that mistake? And it's tough, because bonds historically have been less volatile than the stock market. They haven't been prone to big declines or big drops. They've done the opposite. And they've gone up when stocks have fallen, but they're not doing that. So what do? You've got to then, it's an individual choice. I made mine, but my suggestion is, or what I believe, is that bonds should not be seen as a safety portion of a portfolio. I do buy them still occasionally, very short-term CDs and so forth to park money when I'm not using it. That's what I'm doing in the bond market. There will be a day when I do think we'll see a bottom to what is now a bear market in bonds. That's not today. It's probably years from now. And when it comes, I hope to be buying as an investor. But I do not buy bonds now to hold them for any amount of time. I just use them to park money, for a month, 90 days, because I have nothing, when I believe there's nothing else to do. That's it. But you still want to be diversified. You still want something that, what do you want to do? How do you want to deal with it? Well, there are things that go up when the pressures hurting bonds are occurring, which is primarily inflation. And that's commodities. Commodities tend to go up when bonds go down. And we're seeing that now. Oil is on a tear. Precious metals will go up when bonds go down. And that's why I've got 14% of my money devoted to metals ETFs that own gold and silver, because I think they will go up, driven by further losses in the bond market in the years to come, which could impact the US dollar even at some point. So that's where I'm at, diversifying in commodities and precious metals. That's my solution. That said, historically, and I believe it will still be the case, commodities and precious metals can be more volatile than the bond market. Like the NASDAQ is more volatile than the Dow, meaning the corrections are bigger than you typically see in the Dow, but so are the returns. I think that's going to be the story with commodities and precious metals, that they will be, have bigger annual rises and declines off their highs than what they're used to in the bond market, or what we've seen in the bond market. It's just the way they are. They're a little bit more volatile. And so that's why I'm not going to do a video saying put half your money in precious metals or half your money in commodities. That's probably not appropriate, because they're more volatile. They move more up and down, just as I think it would be complete financial suicide for anybody to put all their money in something like crypto coins, no matter, how much people say they're going to go up, because when they go down, they fall so much. And I don't believe they're going to go up, but even if I did, they still fall so much when they have their corrections. So challenging times, and this requires people to step out of the box that they've been used to for so long, thinking that bonds are safety haven life raft when they no longer are. And this is the primary issue that's going to impact all investors, not simply stock market drops in the stock market, because I do think the stock market can go lower, but if it does, it's going to be things like ARK and ARK holdings that are hurt the most and may not come back, whereas eventually, after a correction or a bear market, the S&P 500 will come back. ARK ETF, I don't think so, and not a lot of stocks in it. There's a lot of stuff we've talked about today. Over the weekend, go speak with a financial advisor. I'm not your financial advisor, but just ask them, what about the bond problem? What do we do about rising interest rates in this environment? Ask them, is this different from what we've seen? What can we compare it to? What can we do about it? Just have a good discussion. They can help you. And now is the time to seek help and talk with people. That you don't do it. Every once in a while, you need to have those kind of conversations. or take the time to really think about this stuff and figure out what you're doing yourself if you're a self-directed investor, trader, such as I am. So it's study time, I believe, for all of us in these markets. Oh, if you're new, never seen me before, click the like button so YouTube knows people like this video, and then they'll show it to other people. Unlike Facebook blocking any negative mention of their company. And then if you're new, hit subscribe and hit the bell, and then YouTube will send you a notification as soon as the next video is uploaded for you.